There's something unsettling about the idea of doubling your money. It sounds aggressive, it sounds risky. It sounds like something other people do, hedge fund managers, tech founders, early crypto adopters, not ordinary people with ordinary salaries. And that belief right there is the first invisible barrier, because doubling your money isn't rare. It's misunderstood. What's rare is patience. What's rare is psychological control. What is rare is someone who understands that money doesn't multiply because you chase bigger returns. It multiplies because you eliminate silent leaks and align with compounding forces already moving beneath the surface of the economy. The shocking part: if you're earning and investing in America today, you are already positioned to double your money. The only question is how long it will take and whether you will interrupt the process before it completes. Most people think doubling money starts with picking the right stock. It doesn't. It starts with a shift in timing. Specifically, what happens in the first 48 hours after your paycheck hits your account. That window decides everything, because money that sits gets spent, money that moves gets invested, and money that gets invested gets multiplied. This isn't motivational language, it's behavioral economics. The average American household operates on a consumption autopilot. Subscriptions renew automatically, credit cards smooth over discomfort, convenience replaces intention, and slowly, without drama, surplus disappears. Doubling becomes impossible not because income is too low, but because friction favors spending. The system is built to absorb your earnings before they have the chance to grow roots. So the first real strategy to double your money faster than you expect is deceptively simple. Remove choice from the equation. Automate investing before lifestyle touches your cash. Because once you negotiate with yourself, growth loses. Now let's talk about something uncomfortable: time. Most people underestimate how aggressive time can be. You've probably heard about compound interest, but you haven't felt it, and there's a difference. When you invest in broad market index funds, historically averaging around 8 to 10% annually over long stretches, your money doesn't grow linearly, it accelerates. The rule of 72 tells you that at 9% annual return, your money doubles in roughly 8 years. But here's the twist nobody emphasizes. That's without increasing contributions. That's without reinvesting tax refunds. That's without salary growth. That's without strategic allocation adjustments. In reality, disciplined investors often experience effective doubling sooner because they're feeding the principal while it compounds. They're stacking momentum on momentum, and momentum compresses time in ways that feel almost unfair. But doubling money isn't just math, it's identity transformation. Most people see themselves as workers. Workers trade time for income. Investors allocate capital for yield. That mental pivot changes everything. When you start thinking like a capital allocator, you stop asking how much do I make, and start asking how much of what I make is building assets. That shift feels subtle, but it is seismic, because once you understand that your invested dollars can generate dividends, appreciation, and reinvested growth while you sleep, you stop obsessing over hourly wages. You begin building something that functions independently of your labor, and independence is the real multiplier. Here's where curiosity becomes dangerous. You will be tempted to accelerate doubling through high-risk speculation, options trading, leveraged ETFs, day trading, momentum stocks, crypto volatility. Yes, some people double money quickly this way. Some triple it, but many reset to zero, and the reset destroys compounding. The true secret to doubling faster than expected isn't extreme risk. It's uninterrupted growth. The wealthy focus less on maximum upside and more on minimizing catastrophic downside. Because if you avoid large drawdowns, you don't have to waste years recovering. Protection preserves trajectory, and preserved trajectory accelerates doubling cycles repeatedly. If you double $20,000 to $40,000, then to $80,000, then to $160,000, something psychological happens. The second doubling feels faster than the first. The third feels almost inevitable. Why? Because your capital is now doing heavy lifting. When your investments generate more in a year than you personally contribute, you cross into a different financial dimension. Your money becomes the engine. You become the strategist. And once that shift happens, time starts working in your favor instead of against you. Now let's address fear, because fear is the silent assassin of doubling timelines. Markets fall. Headlines scream recession. Social media predicts collapse. When portfolios drop 25%, it feels like destruction. But historically, downturns have often been the setup phase for the next acceleration. The S&P 500 has recovered from every major crash over long-term horizons. Those who continued investing during downturns frequently experienced shorter effective doubling periods afterward because they were buying at discounted valuations. But that requires emotional discipline. It requires the ability to separate volatility from permanent loss. And most people can't. They interrupt compounding at the exact moment it is planting seeds for future acceleration. There's another layer. Most people ignore income scaling without lifestyle inflation. When you get a raise and maintain your current expenses, you create surplus fuel. Surplus, when directed into appreciating assets, compresses doubling timelines dramatically. A person investing $500 per month at 9% grows differently than someone investing $1,500 per month at the same return. Both benefit from compounding. but one accelerates the principle more aggressively. Doubling becomes less about waiting and more about feeding, and feeding consistent capital into resilient assets transforms 8-year cycles into potentially shorter effective horizons. But here's the deeper philosophical truth. Doubling your money is less about financial strategy and more about resisting distraction. The modern economy is engineered for immediacy. Fast shipping, instant gratification, viral trends, urgency culture. But wealth building rewards delayed gratification. It rewards boredom. It rewards consistency. The people who double their money faster than expected are often doing something shockingly unexciting. Buying diversified assets regularly, reinvesting dividends, ignoring noise, and staying the course for years. No drama, no hype, just structural alignment with economic growth. And here is the paradox that should make you pause. The fastest way to double your money is to stop trying to do it fast, because desperation leads to risk spikes. Risk spikes lead to volatility. Volatility leads to emotional decisions. Emotional decisions interrupt compounding, and interrupted compounding extends timelines dramatically. But disciplined patience, aligned with historical growth patterns, protected by diversification, reinforced by automation, quietly shortens the distance. Imagine looking back 10 years from now. Two parallel versions of you exist. One invested consistently, increased contributions over time, endured downturns, ignored noise. The other hesitated, speculated occasionally, pulled out during fear cycles, waited for perfect moments. The gap between those two futures is not luck. It's psychological endurance, it's structural positioning, it's uninterrupted compounding. Doubling your money faster than you expect isn't a trick, it's a sequence. Automate, allocate, reinvest, increase contributions, protect downside, ignore noise, repeat. The repetition feels slow until it doesn't, until suddenly your account balance crosses a threshold you once thought was far away. And then you realize something unsettling. The system was always capable of multiplying your money. You just had to stop fighting it long enough for gravity to take over. And once gravity works in your favor, doubling stops being surprising. It becomes inevitable.